From the morning reading, oil rises day 7. The spider has a range day number 11. Many on earnings are moving higher this morning. 3 of 9 sectors moved higher on Friday. XLB, XLK, and XLY were the strongest sectors, while XLU was the weakest sector. Oil futures rose 16 cents to close at 49.12, rising for the 7th straight day, nearing its June 9 high of 51.67. All 9 sectors continue to be year-to-date positive after all 9 sectors had turned year-to-date positive for the first time 2 weeks ago. On the S&P 500 snapshot, a fractional Friday decline ends a flat week. The S&P 500 opened the Friday session with a quick sell-off to its negative 0.54% intraday low. It then recovered about 2/3 of its morning decline at its noon interim high. A weaker sell-off during the lunch hour was followed by a steady recovery to its negative 0.09% intraday high in the final 30 minutes of trading. The index closed the session with a fractional 0.14% loss of the day, which tallied to a tiny 0.01% loss for the week, a week that started with a record close on Monday. The yield on the 10-year note closed at 1.58%, up 5 basis points from the previous close. It's not just August that has seen low volume. While turnover is normally low as traders spend their summer vacation time, it has been abnormally quiet this month. And July and June, except for January and February, all of 2016 has seen below average volume. When stocks hit multi-year highs and such persistently low relative volume, future returns were much lower than when relative volume was high. Black swans are on sale. The last time we had an occasion to look at this was more than 2 years ago, and it led to a large jump in volatility. We're seeing it again as traders are pricing in an increased probability of a sharp, sudden move in stocks, even while that opportunity is being priced cheaply. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:11 a.m. Mountain Time, and I'm recording this in preparation for the market day of August the 22nd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and dive into the morning report. And at the time of this cut, all 4 of the U.S. broad-based indices were down, with the S&P futures down just below scratch, the Russell futures down about 1/4%, as are the Dow futures. NASDAQ futures are also down just a bit below scratch. Crude oil moving, though, down over 2.25%. Euro's down just below scratch. Bonds are up about 0.5%, and gold is down about 1/3%. China's down about 0.75%. Hong Kong up about 1/4%. Japan up about 1/3%. With Germany and the United Kingdom going the opposite way, Germany down about 2/3%, United Kingdom down over 1/3%. In key macroeconomic reports for today in the United States, there are none. Looking forward to tomorrow, we have new home sales, and that's about it. So relatively quiet beginning of the week in terms of macroeconomic reports in the United States. In terms of current volatility conditions, short-term VIX very low at a 9.40, skew somewhat elevated at a 136, so definitely in our warning zone. IV percentiles just about as low as they can possibly be. The S&P's at a 0, the Russell at a 1, the NASDAQ at a 1, and the Dow at a 1. In terms of standard deviation moves, on 3 of the 4 indices there were none, but on the Dow we did have a -1 standard deviation move put in. So kind of keep that in mind. And let's go ahead and go to the charts. Here we go with the S&P futures charts, and we'll zero in on current activity, and you can see we've been basically in a sideways horizontal consolidation pattern for several weeks now. We had the pattern that was the second half of July, had a little bit of a pullback and then a bull flag set up. It broke out, set up new highs, incremental highs several times, and back into another horizontal pattern with a couple probes up and down. Right now we're smack in the middle of that pattern. So the expectation is that this eventually resolves to the upside, but that being said, it is sideways, and that's not exactly making a huge statement for the bulls. Volume, as you heard from one of the morning reading authors, has been very, very low. So while we've been setting these new incremental highs, it has been on the volume of the summer doldrums. We may see some change in that, and we are now August 22nd. We go after Labor Day, we'll probably start to see volume really pick up as people return from their summer vacations and the traders are all in their seats. In terms of the Dow also pretty much in the middle of its current range. Nothing particularly exciting one side or the other here. Very much the same story as the S&P. NASDAQ, of course, has been extremely bullish since that pullback in the post-Brexit period, but certainly in the last week it's been all sideways and no real indication to either direction. In terms of the Russell, that one also went screaming bullish in the post-Brexit period with a couple bigger pullbacks, but still making up for that and making a new 52-week high relatively weekly, some week or so ago, but again, sideways in the week since. Nothing really at any of the indices that's going to get us excited about action or probabilities one side or the other than just an overall bullish bias. But if we look at the other markets, we'll take a look at bonds. Bonds flat out neutral. We're right in the middle of the cloud right now. And we have been sideways in bonds for a month, and there's nothing in what the bonds are doing at this point that gives us much indication. In terms of gold, gold has been in a very sloppy sideways consolidation pattern. The expectation is still for this to eventually break up, but you see there's definitely some diagonal overhead resistance here. At some point, this will probably break up. It's basically coming into a little bit of a pattern between the cloud, the lower triangle support area, and now the upper diagonal resistance. So at some point this will break out, but gold has been a very, very sloppy technical pattern all year, and we continue to watch for that. But in terms of giving us some indication of risk on, risk off, or that the indices are about to move, nothing particularly exciting about the gold pattern. And then in terms of, let's see here, crude oil, let's take a look at crude oil. Crude oil has put in, with recent action, this big short-term move up, broke up above the cloud, and then had a reversal pattern with so far the Thursday, Friday, and then now Sunday night into Monday morning kind of pattern. So it seems to be setting up for something of a retracement. It'll be interesting to see where it goes from there, because while this was, a series of higher highs, higher lows, higher highs, we're now coming into significant area of resistance where the 52-week high and prior swings were located. So we're starting to have to make up the hard ground, and gold seems to be wanting to set up at least a short-term retracement before taking on those levels. Okay, that would seem to be enough for today. Let's take a quick look at volatility. Volatility so far this morning is ticking up, but still within range. Nothing terribly high, and it's still in the 12 handle. So volatility continues to be a little higher just today, but nothing that gets you terribly excited about any indications of where we're going. Let's go ahead and go to the daily report. And we have, of course, our market timing opinions here. And the first thing we take a look at is the market trend intermediate term phase opinion. We are currently in a market phase 3, which is an expectation for bull flags. Of the three market timing signals, all mechanical in nature. Of course, the first one comes to us from IBD, is in a bull phase, confirmed uptrend. The second one, also bullish. GMI index is at a 5 out of 6 with a buy signal that's been in place since July the 1st. GMI 2 still 7 out of 8. Stock charts decision point scoreboard. We do have a new signal that came in here on Friday, and this continues to muddy our short-term look. On all the indices, we have short-term and long-term all in mixed signals, which gives us the indication to expect very choppy markets. Overall opinion here is bullish, our bullish bias, but yet at the same time that not likely to see any significant bullish legs or bearish legs until we start to see more resolution of these time frames coming together into more of a stack. Position sizing opinions on both models, the portfolio investor position sizing as well as the volatility active trader position sizing, are both at 100%. Intermediate term market posture for all four indices is still severely strong bull, and that is also supported by a bullish sentiment line. Strength of the trend continues to also be very, very strong. Hedge warning status 0+, normal with some cautionary aspects. Mostly notable is these decision point mixed signals, and until those resolve, we'll probably leave this at least at a 0+. In terms of strategy opinions, VIX is currently borderline acceptable to initiate new positions. As of Friday's close, the VIX was below a 12, which makes the amount of premium available relatively low versus the amount of risk. So for novice traders, not an ideal circumstance. Now, as we go into the opening today, we're looking right now at this being up over 12, so we'll watch and see if this closes back within the window. In terms of cover call strategies and put sellings, no differences here. We're still at this 1-to-2 ratio of in the money versus out of the money strikes, and also in terms of the portfolio composition, a 1-to-2 ratio of low beta versus higher beta positions. Everything pretty much a-okay to go for cover call strategies and put selling. With this kind of sideways action, haven't had a lot of great opportunities for put selling, but watch your individual charts and you might make some decisions just based on the individual charts. In terms of the individual areas of concern, you have in the volatility area, we have several signals here, including the ratio warning. It's sitting in the firing area but has not yet fired. Also, skew is elevated, running about a 12% probability of a 2 standard deviation move for the next 30 days. Distribution day count for both the NASDAQ and the S&P continue to be elevated. We're still in that VIX daily squeeze. You know, obviously, when volatility does expand, we would expect a pretty significant expansion to come out of this daily squeeze. In terms of the trend base, everything's very bullish here, nothing particularly exciting. Key intermarket risk aversion indicators, we've had some weakness come into this of late. One of them's at neutral, one went outright risk off with Friday's action. The other three are still modestly risk on. So mixed signals there, and not terribly clear as to which direction this is trying to rotate with so much neutral in the indicators. In terms of short-term sentiment, that ebbed off a bit with Friday's action, but sentiment is somewhat elevated on the intermediate term. That, along with the fear and greed index up here in the upper quartile, we're currently scoring a 77, would indicate to us that we need to continue to watch for reversal patterns. In terms of sector specific, telecom, consumer discretionary, healthcare, and utilities have all continued to be struggling in recent action, and that continues to be true. And you see on Friday we had really only modest heroes in terms of information technology and materials were up. Industrials and consumer discretionary are basically scratched, and everybody else was weak. With some more than a little bit weak, energy, telecom, and utilities especially. So for the most part, the risk-off, more defensive areas of the market were the ones that were setting up for weakness. On the relative rotation graph, you continue to see a lot of participation by different industry groups in this upper right quartile where we want to see them, though most of the action this last week was, a little bit of a tailing off kind of thing. Still, biotech, the internet index, we have a position in the trade room in this one. Also, real estate, IYR, that's your REITs. Also in that upper quartile, and then home construction and semiconductor making out the others that are currently scoring in that upper right quadrant. I think that's probably going to be enough for today. Let's go ahead and get to the disclaimers. We're running a bit late to go into publishing today, so here we are with the disclaimers. Hit the pause button if you need more time to review the disclaimers. Also note this hyperlink down here at the bottom for the full set of disclosures. We'll see you back here tomorrow for the Falcon Global Market Preview. In the meantime, manage that risk and you'll find that everything else falls into place. Go out there, seek to learn something. Good trading.